Good afternoon and good morning to Sascha Bützer from the US, from Washington, to a discussion that we are very happy to have and to have you both on the line online on a very important issue, which is a little bit more fundamental, but maybe very relevant to the current discussion around inflation. And the big issue and big question, if this has been due to wrong central banking policies, to asset purchases, bonds purchases from central banks, which is a case that is made by a lot of economists. So this all turns around the question: how should the central bank do the job? Maybe it's not about, it's not the best solution to not intervene, and maybe there's a more or less consensus on this. If there is a crisis like the financial crisis, like the euro crisis, like in a situation like the Corona crash, let's say, or earlier this year, the question still is, if one is in such a situation and there is maybe something like a deflationary, disinflationary structural bias, what should the central bank do and how should the central bank react to that? So we know more or less, we know what the central banks have done in the last couple of years, but maybe this has not been the ideal way. So maybe there's a solution between not doing anything and doing what the central banks have done. And this is about the paper that Sascha Bützer has presented a couple of weeks ago, which has been widely discussed also inside of central banks, about what people call helicopter money, which is the idea to give money not by buying bonds, but sending money to people, which is very popular on one side, but very disputed and very criticized as an idea by others. Still, there have always been some very prominent people who have defended the idea, and Sascha has worked on this and presented a paper where he developed much more in detail how this could work. We're happy to have you, Sascha, as the author of this very important paper, and as an economist at the IMF. I think it's usually known that what you write in such a paper is not the official position, the policy of the IMF, but that's something you can perhaps hint at some point. But still, having an IMF economist working on that is still something which is quite remarkable. And so we are happy to have you presenting the paper in a minute, and we're happy to have Dorothea Schäfer, who's head of the director of financial markets at the DIW Institute in Berlin, an excellent expert in financial markets and central banking. So very happy to have you as a commentator of what Sascha will present in a minute. I will hand over to you, Sascha, and please tell us more about what you have developed in the paper that you have written. Thank you.
Yes, thanks a lot, Thomas, and many thanks for the invitation. I'm very, very happy to present my findings here today. As you said, of course, this is not the official position of the IMF, as also shown here in the disclaimer, but my personal view as an economist. That's also the beauty of working at this institution, where you have a wide spectrum of views and different ideas coming together, and all in the pursuit of promoting good economic policies. Let me go to full screen here. So this, as Thomas mentioned, is based on a recent IMF working paper. Can be easily found online if you're interested. Where the first part focuses on what I call outright transfers, since it's a bit more of a technical term, as helicopter money means different things to different people, and also has been laden with some preconceptions in the public debate. And I will explain in a bit more detail what I mean with this. So just as another disclaimer, in the current situation where we have inflation which is way above target, this is not a policy I would recommend by any means. So it's not geared to the current situation, but rather it focuses on, is there something central banks could have done differently, basically over the last 10 years, when reserve currency issuing economies such as the euro area, the Federal Reserve, the Bank of England, were basically operating at below target capacity, with interest rates very close to the effective lower bound or at the effective lower bound, that is close to zero or even negative, and engaged in large-scale asset purchases in order to counter that environment, in order to achieve the primary mandate of price stability and support other economic objectives. Now, this is the first part of the paper, whereas the second part of the paper actually focuses on central bank solvency considerations. That is, risk to how can risk to central bank balance sheet be managed that stem from such an operation of direct transfers. And this is an element of the paper that is very relevant also at the current juncture, given that central bank balance sheets have increased enormously in size due to QE over the past years. And many central banks now face the challenge of how to unwind these or how to deal with the associated costs. And again, I'll explain in a bit more detail in a few minutes. Now, as Thomas has mentioned, this paper builds on policy proposals that have been hotly debated and that have been put forth by some of the world's most eminent monetary economists, such as Jordi Galli, Ben Bernanke, Der Turner, Willem Buiter, and others. And there's a long list of policy proposals that usually have not been fully fleshed out in an academic paper, which is what this paper contributes to. So it provides a detailed discussion of the practical implementation options and the implications for central bank balance sheets. It also shows why it is not the same as a debt or a money financed fiscal stimulus, which was often put forth as a counter argument, saying, well, why can't you just engage in fiscal stimulus and its equivalent? And those differences are particularly pronounced in the context of a currency union, such as the euro area, that lacks a central fiscal capacity. And lastly, I'll also, in the paper, touch in greater detail on the legal institutional considerations of introducing such an instrument, given that this has been front and center, for example, in the euro area, given the legal debates surrounding the ECB's actions, and also, of course, the monetary financing prohibition that has called some of its actions into question. Now, as a brief motivation, I just want to show these two charts. On the left-hand side, you can see the blue line is the total assets in the euro system, which have been increasing quite rapidly since the start of quantitative easing in early 2015. However, and this is the red line, this has not translated very well into supporting domestic demand in the euro area. What it has driven to a large extent is the very large increase in housing prices, shown as the light orange line, as well as in the stock market, shown as in the green line. And of course, there's a lot of different factors. The low interest rate environment contributes as well, which again is another outcome of asset purchases. But just to show that the transmission has not been as direct into demand or into prices, the primary objective of the ECB, as shown on the right-hand side. So if you look at headline and core inflation between 2015 and 2021, the European Central Bank has continuously underperformed meeting its target, accumulating a large difference to its stated objective. Now, of course, over the last 12 months, the picture has changed a lot. That's why I excluded here. But this is not so much due to central bank actions, but rather due to the compounding of supply side shocks, be it from COVID restrictions in China, be it the Ukraine war, of course, and then also some of that large stimulus, particularly here in the US, trickling through into demand. Now, what does that mean for the wealth distribution? If you look at it in the European Union, most of the assets are owned by the top 10%, close to 60%, out of which about 25% only pertains to the top 1%. So that mechanically, a large increase in asset prices disproportionately benefits the rich in absolute terms. Sometimes some studies find it doesn't alter the Gini coefficient that much, but that's because it's a relative measure. And if assets go up across the board by 1%, a person who owns $1 billion in assets rather than 1,000, of course, will be much better off. So this, as a small motivation, as a segue into the proposal, the major drawbacks of QE are fairly well known and broadly discussed. So I will skim over them here. But I think the last point here, which I hope we will also have an interesting debate on later, is how to actually deal with a central bank balance sheet legacies going forward when central banks want to raise interest rates. And that's actually an issue you don't really face if central banks would have engaged in direct transfers instead. Now, and this kind of tries to distill a lot of content of the paper into one slide. Basically, the economics of outright transfers are fairly straightforward. It would raise the net private wealth of households and aggregate demand directly, rather than trying to boost a new debt creation through QE. In the euro area, it would actually have the additional benefit of having asymmetric effects. That is, different real and price effects depending on where a country stands in terms of its output gap and marginal propensity to consume. And rather than a beggar thy neighbor policy, it would actually have positive spillover effects both within and outside the currency union. It would also, and this is key, it's a distribution neutral monetary policy tool, something that you in principle want to achieve with monetary policy, given that it's implemented by technocrats rather than by elected officials, and would be fairly easy to implement through either checks, perpetual zero coupon teltros. Not going to go into too much detail about that right now, but Eric Lonergan, who has been a frequent contributor here, has invented this concept, or in the future through a central bank digital currency. It would also not distort relative prices, something we've seen on financial markets, of course, in the past years, and does not violate the monetary financing prohibition. Or, and this also again has been very prominently now been put to the forefront, create a social fiscal dominance concerns that certain stimulative actions cannot be unwound that easily. These are basically two stylized central bank balance sheets, and in view of the time, I will basically skim over them, but they are in the paper if you're interested, and we can also revert back to them later. Now, in terms of the magnitude, the ballpark figure for a desired boost of around nominal GDP of 1% would require a transfer of close to 500 euros to every adult citizen in the euro area, which depends on the specific assumptions one has about the domestic multiplier, the marginal propensity to consume, which is also it depends on the business cycle position. So there's no one number, but just to give you a figure what we're talking about here. And operating under this assumption, this would require an increase in permanent central bank money of 125 billion euros, which is less than 1.5% of the Eurosystem's current balance sheet of 8.7 trillion euros, and around 5 times the Eurosystem's average yearly seigniorage. Just to give you an order of magnitude, given that it creates a loss for the central bank, which would have to be paid down in the future through future seigniorage gains. Taken together, this number is far below conservative estimates of a central bank's non-inflationary loss absorption capacity, which I've again in a back of the envelope calculation tried to visualize here for the Eurosystem, where you can see the outright transfer operation at the very bottom, and then using different assumptions, taking capital revaluation and currency in circulation into account, you get to a non-inflationary loss absorption capacity that is orders of magnitude higher than the original operation, which matters insofar as it doesn't endanger the solidity of the central bank balance sheet. If you approach that non-inflationary loss absorption capacity, that's really where you, of course, are in trouble as you'll become policy insolvent. And I'll have a small slide on that here as well. So as I've alluded to, is that the downside of having outright transfers implemented by the central bank directly to households is that the central bank doesn't acquire a corresponding asset on its asset side that it could sell in the future. This would mean it takes a loss to its equity. It could potentially even lead to negative central bank equity. And it also will face a remuneration cost of the newly created reserves that commercial banks will hold with the central bank as a consequence of this operation. However, and this is important to note from a general equilibrium perspective, the net present value of the central bank's balance sheet could actually be even higher as future seigniorage gains increase since the central bank earns seigniorage from its interest rate differential between its assets and liabilities. However, you cannot operate this as a permanent measure, so to speak, as if the central bank balance sheet is weakened too much, the central bank can lose its ability to independently control inflation, for example, by raising interest rates and remunerating reserves without having to print new base money. So on this, there's no hard threshold that can be identified, but assessing the non-inflationary loss absorption capacity, which I've just shown, can provide some orientation. And lastly, on the slide, and I think this is a very important point, is that in the debate around helicopter money and QE, often it was perceived that, this would create this direct cost, helicopter money, to the central bank, whereas actually the cost and risk to the central bank balance sheet under QE are arguably much higher for the same bang for the buck that you can get for each operation due to the interest rate and fiscal dominance risks that are associated with it. And I've tried to visualize this in these two charts. On the left-hand side, you can see the upfront costs of direct transfers would, in this example, be 125 billion, and they don't change over time, regardless of what the change in the deposit rate will be. However, under QE, due to the very large increase in the central bank balance sheet, a change in the deposit rate would immediately have a very large cost to the central bank balance sheet. And on the right-hand side, so this is basically on the left-hand side, would be a mark-to-market loss, which, according to prudent accounting rules, the central bank would have to follow. Or if the central bank decides to sell assets acquired under QE, it would take that direct loss. Now, on the right-hand side, you can see the recurring costs, which again, immediately are higher under direct transfers, if small. But as the deposit rate is being increased, or the policy rate, the reserve remuneration cost of QE basically can increase to very, very high amounts. And this example is calibrated to yield an impact on nominal GDP of 1%. For QE, this, in this example, would constitute around 1.5 trillion euros. Now, we've seen the European Central Bank's balance sheet is actually much larger than that. So assuming you have a balance sheet size of 10 trillion and you start remunerating those newly created reserves at a policy rate of 2%, that would mean an annual cost or transfer from the central bank to commercial banks of 200 billion euros. And this is something that I think has been not much discussed in the current debate, and that we should shed some more light on. Now, is there a way how to deal with these associated costs? And there is. There's actually also been a very nice paper by Frank van Lerven for the case of the Bank of England, where it basically makes the same points that I make on this slide, is that historically, central banks, including in advanced economies, used to employ reserve requirement and remuneration policies much more actively. They still do in some parts of the world. China, for example, is a good example. And what, for example, prior to the financial crisis, the Fed or the Bank of England did not remunerate their excess reserves at all. So what this would mean is if we move to a system where we have a tiered reserve remuneration system, where you can enforce a certain policy rate, this would imply implicit tax on the banking sector. However, this is a feature and not a bug, as it amplifies the contractionary effect of this policy. Moreover, commercial banks would be in a much better position to absorb this tax due to an increased interest income as the economy lifts up from the effective lower bound. And overall, this is something that central banks might want to reconsider. There's actually, when I wrote the paper, a found a lot of interesting papers going back to the 1990s, including from the Bundesbank. Actually, the point was made why reserve requirements should not be remunerated. And in the current environment, it should feature into the debate on how to find the best policy mix to deal with above target inflation in the least disruptive and costly manner. On this chart, you can see on the left side, the interest rate corridor in the euro area as it has been in the past. Whereas on the right-hand side, I show how you can enforce that interest rate corridor going forward while having a minimum reserve requirement rate in orange that is far below the policy rate and does not create additional cost to the central bank, or eventually the seigniorage it remits to the taxpayer, to the fiscal authorities at the end of the year. Now, and I'm almost at the end of my presentation here. There's some key differences between direct transfers and a debt finance fiscal stimulus. And I mention this because some pundits, economists have argued, well, isn't this just equivalent to issuing short-term debt and engaging in fiscal expansion? And it's very different for a number of reasons, particularly in a currency union. So for once, central bank liabilities are state contingent. That means the issue of potential remuneration only arises if the policy actually works. That is, you create inflation, you get to your inflation target of 2% in the euro area, but only in that type of environment where you then overshoot will you get into the situation that you might have to remunerate these reserves by raising interest rates. Moreover, and this is crucial if you look at the euro crisis 10 years ago, where many countries faced sudden stops and rollover risk, central bank liabilities do not face that problem. So it really does provide a net benefit by pooling, by taking that risk away. And lastly, including through this feature, it would improve intra-currency area risk sharing, as it is a mutual liability on the central balance sheet, and would support convergence due to its asymmetric impact on different member state countries. The last part is a little technical, but what it does in essence is it provides a tool for intertemporal smoothing of seigniorage on the central bank balance sheet. Might be an overwhelming slide, so I'll leave it at that. This is just for people who really want to dive a little deeper into the differences. But in this slide, on this chart, I tried to visualize a little bit the key differences between OT, QE, a money finance, and a debt finance fiscal stimulus. And again, it's in the paper if you want to dig a little deeper. And I believe this is my second to last slide. So I just want to briefly touch on when I have been presenting this paper to various audiences. One of the biggest or one comment I usually get is that, well, this is all, the economics all sound good and right, and it sounds very appealing, but what about the institutional legitimacy? Can central banks actually do this? Should they be doing this? And as I would argue is that from an institutional perspective, it's a prerogative of fiscal policy to decide on redistributional issues. Should the rich be taxed and given to the poor? If so, how much? This should not be the prerogative of the central bank, but that's exactly what central banks have been doing through QE, is actually, of course, not intentionally, but alter the wealth distribution, both in aggregate, but also within, depending on whether you're creditor and debtor. And that has created a lot of the pushback against central banks, in my opinion, over the last 10 years of people who were not very content with these type of policies. So in this case, you basically have no redistributional impact at all. And moreover, direct transfers from the central bank to private actors are already a feature of the current Eurosystem's institutional framework, as central banks transfer money that would otherwise be seigniorage to the general public to banks through the tiering of deposit rates and TLTRO 3. And there's actually a nice working paper by the Banque de France on this. However, and this is a key point, it would be a large deviation from how central banks have traditionally conducted monetary policy, that is through the financial sector. In view of this deviation, which I think is warranted under the circumstances, under the somewhat extreme circumstances that I've laid out early on, it would be desirable to have a clear legal foundation in central bank frameworks, institutional and legal frameworks. Right now, interestingly, the Eurosystem Statute Article 20 allows for other instruments of monetary control, and statements, for example, by Mario Draghi and Peter Pratt have alluded to the possibility of conducting such an operation. But in principle, given the large deviation from the status quo, it would be desirable to actually have a sound and clear legal foundation in central bank law. Let me conclude now with some more general remarks summarizing my presentation. In my paper, I've tried to show that the addition of OT to the monetary policy toolkit would allow central banks to achieve their mandate in a more effective and equitable manner. It should be implemented in a data-driven approach. That is, it should be contingent on the inflation target, similar to how central banks basically operate any other monetary policy tool. Have it clearly communicated to the public to show that this is not an operation that there will be free checks coming every year, no matter what the state of the economy is. And as a third point, I would encourage central banks to more actively consider active reserve requirement and remuneration policies, regardless of direct transfers, but also in the current environment of very large central bank asset balance sheets. And lastly, this paper is only supposed to provide a starting point for future research. For example, quantifying the trade-offs, the costs and risks of outright transfers versus QE, depending on, for example, the shape of the yield curve, the state of the economy, and other factors that might influence this decision. Let me stop here and hand over to Dorothea and Thomas for comments now.
Thank you, Sascha. Thank you very much. I immediately hand over to Dorothea Schäfer to comment on the paper, please. Go ahead.
Okay, then I want to share my screen as well. I hope that this will, yes, it will. And okay, so now my input starts with more basic questions, which are also mentioned in the introduction to this session. So first, have central banks contributed to the recent inflation shocks with low interest rates and bond purchases? I think no, they have not contributed to this. This is a supply side driven inflation. We were confronted with repeated corona supply shocks, supply chain distorted within the European Union and outside. In addition, the war in the Ukraine exposed us to severe restrictions in energy supply, which drive energy prices to unknown levels and affect basically all prices. So the supply shocks created scarcity. Scarcity eliminates competition as a price stabilizer. For competition to work again, either the supply has to be increased, that means repair of supply chain, alternative energy production, or the demand for goods and energy needs to go down. An example from the Frankfurter Allgemeine Zeitung nicely illustrates that the role of competition in relation to scarcity. So the article has the headline, "The Return of Discount Battles," and it tells the reader that the demand for new kitchen furniture has gone down because, and then this is the return of the discount battles. And the reason is that households either expected or already felt tighter budget constraints. And this makes it difficult for furniture manufacturers to pass increased production costs on prices and to increase margins. Would outright transfers or helicopter money from central banks help to tame inflation pressure? No, at the moment not, presumably, and as Sascha already mentioned, that they would contribute to the contrary because supply is in many areas too low for the demand. Have central banks contributed to the recent inflation shocks with low interest rates and bond purchases? No, an unchanged demand, possibly even increased due to the savings overhang from the corona restrictions met with a lower supply of goods. The prices then rise until the real purchasing power of the citizens has adjusted to the lower supply. The central banks can't do anything about the reduced supply of goods, and they can't do anything about the pent-up demand due to the corona-related previous drop in demand. Raising interest rates to tie up excess purchasing power was no option. That would have increased the risk of a widespread decline in asset prices and would have hit the financial system even more than the lockdowns had already done. The central banks fought against the meltdown, and I think they had to. And have central banks contributed to that asset values have risen so sharply for years? Yes, they have. Asset purchases lowered the discount factor for future cash flows and increased the value of assets and thus their prices. The interest rate was even negative territory, even pushing prices more up. But asset purchases at the beginning of the corona crisis were used to avoid a meltdown of the financial system. This is important, in particular, if your complete retirement system is based on assets. Thankfully, this is not the case in Germany. Asset purchases can do that, avoid a meltdown by lifting up the asset prices again. But would outright transfers have the same power? I would doubt that. And are the central banks responsible for the sharp asset increase or value increase in the previous years? They have also, of course, asset owners have benefited from central banks' asset purchases. Central banks' asset purchases have two effects on inequality. On the one hand, asset owners, mostly at the top of the wealth and the income distribution, have benefited from central bank purchases. On the other hand, highly indebted households have also benefited from low interest rates. Either follow-up financing could be concluded at lower interest rates, or if the interest rates were variable, then the interest burden was reduced immediately. And households with lower incomes have also benefited from through employment effects. And in particular, the taxpayer has benefited from the low interest rates, as the interest rate burden has decreased. For example, Germany has a debt level of 2,476 billion euros. And it paid in 21 an interest payment of 20 billion euros. And that is an average interest rate in 21 of 0.85. In 2005, this interest rate, that is the amount of interest paid divided by the debt level, was 4.8%. So would have had Germany to pay this average interest rate of 2005, then the interest burden would have been 100 billion euros. So there is a saving of 80 billion euros. And of course, if you start later, for example, in 2007 or 2009, then the savings would be less. But the savings, in any case, the savings would be considerable for the taxpayer from the low interest rates. The main message of the paper is that it is more neutral in terms of inequality. And this is presumably true. It has much less impact on central banks' balance sheets and less exposure of central banks to a loss in valuation And the impact on the central bank's equity is lower, presumably, than it would be from the asset purchases in case the values of the assets goes down considerably. And Sascha said it is effective at the lower bound, or more effective at the lower bound. Outright transfers would allow for faster liftoff from the effective lower bound. Maybe Sascha should explain this in more detail so that it would be more easy to understand why it is more quicker or quick liftoff from the effective lower bound that can be ensured by the OT. And could it be used right away? No, and that is, as Sascha already pointed out, because inflation is not below the target right now. Then I have some technical issues. Could the ECB indeed send to all adult citizens of the Eurozone a paycheck? What technical problems are there, which we have not discussed yet? Think of the current discussion on how to give households a certain amount to ease the energy price burden. This seems to be very difficult. Usually it's said we have no infrastructure for this. I am not sure whether this is a reliable argument or an argument taken out of the closet to bring down the demands for this kind of transfer. But the discussion is there and it is heavy. So this has to be clarified if OT should be a serious option. Most easy way to distribute it would be if central bank have digital currencies or issued digital currencies, and each household or each person has a direct central bank account. But we do not have that yet. So it's not so easy to really distribute it. The political solvency is an important issue that is already known from the presentation of Sascha. But for ECB, it is important that it is within our mandate. Is it truly within our mandate? And what about the European Union versus Eurozone? Should all central banks within the European Union follow the ECB in outright transfers? How would the goal of creating 100 billion euro of additional GDP be distributed among the Eurozone countries, according to the shares in the ECB capital? So this could be a fight within the Eurozone. Would it be a tool to better avoid fragmentation? If so, how? In the paper, I didn't really find a hint whether it is better to avoid fragmentation, and fragmentation is right now a very serious problem. There is the sentence, OT improves intra-currency area risk sharing and supports convergence. So it should be outlined and explained in more detail how this would really work. That hints into the direction that it would be suitable or able to better avoid fragmentation as we have instruments now. Concerns about lengthy fiscal procedures. Sascha pointed out that it is a big advantage that we have not these lengthy fiscal procedures, but these concerns also highlight the risk of circumventing democratic processes. Yes, I know this applies to asset purchases as well, but I think in the end it boils down that if equality issues are concerned, the democratic processes should be strengthened, and this would definitely mean that the solution should come out of the fiscal budgets. To sum up, I believe that it could be a fruitful additional instrument, but I have some doubt that it would really substitute asset purchases. So it could be a complementary instrument rather than a substitution. Yeah, that's from my side. I hand over to Thomas.
Thanks very much for this excellent comment and a lot of questions. I think maybe we can start, Sascha, with the last one, which is maybe not the most logical one, but maybe the easiest one. Would you agree that this is more like a complementary tool, if ever that gets to the point that it may be applied, or should this be something which should be at the place of OMT or other instruments, quantitative easing?
Yeah, actually, I would tend to agree with that, and I think I would tend to agree with most of the comments that Dorothea has made in her remarks. So as a complementary tool, I think there could be a useful role, given that QE's effectiveness decreased over time as the yield curve flattened, right? So if you actually have a very steep yield curve and you engage in asset purchases, you can get a bit of a bang for the buck, right, by lowering rates at the end of the yield curve. So there's the risk-return trade-off is a bit better, so to speak. I think the real problem you run into with QE is when the yield curve is largely flat, which happened in the euro area, very, very shortly after the beginning of QE, when you're really pushing on a string. So then you're just pumping liquidity in financial markets without getting much in terms of an effect on interest rates that you're trying to lower. And I think that's where OT has actually the biggest advantage over QE. On the side of on the fragmentation issue, maybe, where I also agree, actually the biggest drawback of direct transfers versus QE is that it does not pamper over those fiscal sustainability issues, which arguably should have been resolved more forcefully 10 years ago, for example, by restructuring unsustainable debt, bailing in private creditors and so forth. But so those were the mistakes of the past. But in the current situation or in future cases, you don't necessarily need QE to prevent those extreme tail events, right? You could, in principle, have an operation of direct transfers in order to achieve your primary mandate, in order to achieve your price objectives. But if you want to prevent a crisis spiraling out of control, you can combine it with an anti-fragmentation tool, similar to the one that the ECB has started implementing now, where you prevent those self-fulfilling prophecies from kicking into place. So yeah, I believe it doesn't have to be strictly either or, but you should really look at the risk-return trade-off depending on the situation that you find yourself in.
Maybe one question that I just throw in, but then I think there are some other questions that Dorothea has raised, and maybe you can recall them. I understand if you give this money to people and this will immediately have an impact, or quite quickly an impact on demand. What if the reason for the insufficient demand is something structural, or something like in a crisis time, or so is that something? I mean, that's a short push. That's something which is immediately ending. It's not really solving structural issues, if there's a structural issue at all. So what would you say in that case?
Thanks. Yeah, I think on this, I'm again in fully agreement with Dorothea. Say, well, look, what we've seen over the past year is actually is very much structurally driven, supply side driven, and there you should, you know, this is a bit outside of my paper, but I have a paragraph in my paper saying, you know, the first best solution would be to address also shortfalls of demand and shortfalls of capacity by the public sector playing a very productive role, and for example, you know, engaging projects that both close the output gap in the short term and raise potential output over the medium term, right? For example, investing in the green transition, investing in infrastructure, things that, you know, we've neglected for a very long time that really come to bite us now. So I think, you know, that would be the first best. My paper, and, you know, I started writing it a few years ago when we were more in the situation that fiscal policy could have supported economic activity much more forcefully in the euro area and prevented a large downturn in unemployment due to a lack of domestic demand. And I think that's where direct transfers could play a very important role in augmenting the macroeconomic policy mix. But in principle, I fully agree. It does not do anything to really tackle the big challenges, the big supply side challenges, be it climate or inequality, that we need to undertake in order to really foster sustainable long-term growth. Mm.
I mean, there are some studies saying, even by the Bundesbank, that there's an impact on inequality on consumption, because I mean, big debate around this, but as income has gone to people who have a high saving rate, in that case, just transferring once or even twice or 3 times wouldn't change the fundamental inequality issue. Dorothea.
I haven't really understood how you can avoid this gap that also the QE faced. They produced a lot of money, and somehow this money arrived at the households somehow, and it was put on banking accounts, and it was not really fueled back into the economy. So on banking accounts, a lot of money was accumulated, and it was not active in the sense of creating additional GDP. And as I understand your paper, you would not really select some households which have a very high to households which can save, which have extra money left, and what does it? How do you really ensure that they do not just put it into the banking account and leave it there, so that it is, you are expecting that that the money goes to into the economy. So and you say, and this is this is clarified by the marginal propensity to consume and by the multiplier that you use. But for households which are so in the upper part of the wealth distribution, the marginal propensity to consume might be very low, and then the multiplier is not so strong in this part of the population.
Thank you. Yeah, maybe let me respond to that quickly. I mean, just to clarify, the mechanism between QE and direct transfers is very different, because QE through asset purchases, the amount of base money, central bank money in the economy goes up, does not have a direct impact on broad money. because commercial banks cannot lend out reserves. And I think that's the popular misconception that's also been, prominent in the German debate, where, the narrative was, oh, the central bank is printing so much money, which the banks do not lend out. The banks cannot lend out, by definition, central bank money, because private actors, non-financial actors, do not have access to central bank money, central bank accounts. So the way QE works is through lowering interest rates and then trying to incentivize additional credit creation. But that's not necessarily a given. Now, with direct transfers, you immediately boost broad money. You immediately boost the balances of private households in their commercial bank accounts, which then is very similar to what we've seen with fiscal checks. And there's a large literature going back to the great financial crisis, which basically show you have a marginal propensity to consume over 4 quarters of close to 80%. So that's just, the empirical evidence. And in the case of the US, we actually saw it work maybe too well. If you look at the round of stimulus checks from President Biden a year ago, the policy debate here as well, oh, was that really necessary? That might have been too much. Maybe it was a little election present, but now it contributes to the overheating. And from the perspective of my paper, it would actually be beneficial to give these checks from the central bank contingent on the inflation dynamics, right? To kind of like take that away from the fiscal side and say, well, look, we should use that as a monetary policy instrument to support aggregate demand, but only if it doesn't contribute to overheating. So I think those are key differences. And that's also why, and you asked in your comments, right, why would direct transfers enable a faster liftoff from the effective lower bound? It is precisely because it has a much more direct impact on the real economy than QE, due to its effect on private actors' balances rather than commercial banks' balances. And maybe just a very quick point on Thomas' point, which I thought was very good on inequality, is yes, you would actually expect not only a cyclical effect of trying to get out of a slump faster, but you also avoid hysteresis effects of getting stuck in a slump for longer, which then, and by not increasing inequality, something that asset purchases contribute to. And there's an emerging literature on the pernicious effects of too high inequality on long-term growth, due to the, as you also mentioned, the much higher propensity to save of richer households, so that money is not being recirculated in the economy, so to speak.
Okay, Dorothea?
May I
Yes.
just one remark? So Germany, during this long time where central banks try to increase inflation and brought down the interest rates, the German economy was always in a good shape. But the weak economies were with other countries, Greece for a while, and Italy in particular. So, but how would your tool avoid this disbalancing in the strength of the economy?
That's an excellent question. Thank you for that, because basically, and I explained this a bit in greater detail in the paper, basically if you have a transfer of equal amount to each adult in the euro area, then an economy that finds itself harder hit, compare, for example, during the financial crisis 10 years ago, the slump in Greece, where you had a massive economic contraction, to Germany, which was holding up pretty well, you would expect that the transfer of the same magnitude would yield a much higher effect on economic activity in Greece rather than Germany. Whereas if Germany is operating closer to potential, the money that is domestically would probably have more of a price effect than a real effect. And that's exactly what would contribute to the rebalancing, right? If you still remember that debate of how, some countries have to become more competitive, then others not necessarily something I would ascribe to, but the tool would allow that you create the biggest real effects in the economies that have the most spare capacity, generally speaking, whereas you would see more of a price effect in economies that are operating already at potential. And again, this was 10 years ago. This was a key point. If you want to achieve an inflation target of close to but below 2%, that means some countries will have to be above 2%. Some countries will be below 2%. If everybody's below 2%, that's, you're not getting there. So again, that's maybe in a nutshell how a direct transfer of equal magnitude would contribute to those convergence processes within a currency area.
Okay, there are some questions. I mean, a lot of those maybe we will check and hand over to Sascha, and you can check in and maybe answer separately. But in a way, they are touching similar points. Maybe on the legitimacy question, I didn't yet understand how you would imagine, or if you are still already imagined in that sense, how this would happen. Would the central bank decide this on its own, how to apply, how to decide, or is that something that very practically would have to be decided in the Eurozone in cooperation with whatever the Commission, the governments, who then would have a much more solid democratic legitimacy to say who will get the money and how you can spend it? That would be something that I would imagine is a real thing, where we can imagine that central banks are a little over there or beyond their competences.
Thanks. I mean, again, this is not really my call to make, of course, but generally speaking, the governing council of the ECB does, of course, make monetary policy decisions, taking, it's under its primary mandate, taking a number of things into account. And in my paper, I'm arguing, but I'm not a lawyer, so this is, take this with a grain of salt. But if you see the legal criticisms that have been levied against the ECB, that it's, that its asset purchases have, had a disproportionate effect on distribution outcomes, and also in front of the German Constitutional Court, of course, those are all criticisms that direct transfers wouldn't be subject to. So you can actually address a lot of that criticism that has been leveled against central banks from a popular perspective through this tool. Now, that being said, it's not explicitly in the monetary policy toolkit. The legal framework is ambiguous. Also, when I discussed this with lawyers, there's no clear answer to this, as law is also an evolving discipline. It's not, everything is hard. It's not something that falls like manna from heaven, right? So, but I could imagine that undertaking such an operation with very clear economic benefits and very clear social benefits would be very hard to turn over in front of a European court of justice when it actually achieves the stated objective of the central bank with very minimal side effects. So maybe these are my 5 cents on it. And as I see another question in the Q&A, and Dorothea had also asked it, let me maybe also address that quickly. It's about the technical implementation of direct transfers, which in the presentation I only spend 10 seconds on. So I would argue it's actually fairly straightforward. It's it's never easy, but it's straightforward. So how direct checks in the US were implemented, it was basically, from the fiscal authorities to all the taxpayers, right? But even if you weren't a registered taxpayer, you could come and get it. In the European Union, we have electoral registers for European elections, right? So those registers exist. They're actually freely accessible upon request in many countries. So this is something central banks could harness. Another option, and this is a bit more in the CBDC literature, but this would actually, if we do move to a system where we gain private citizens access to central bank money through central bank digital currencies, this would be a very easy way to provide injections, but also to withdraw money when it's not needed, right? So you could imagine, given the stimulus of 500 euros, but attach a negative interest rate of 10-20% to that, because that would incentivize that it's being spent very fast rather than saved for and then spent in the future when it's not needed. But that's just something that other research will have to focus on. And a third idea which I think is very appealing, which you could do within the existing framework, is a perpetual targeted long-term refinancing operation, which the ECB has already been doing, which other central banks in similar style have been doing, which would basically mean that households would get a perpetual zero coupon loan from the central bank, which is essentially valued at zero, with banks serving as intermediaries to pass on that loan to households. And the banks could be incentivized to participate in that by being allowed to charge a small fee. This is a very technical proposal, so I would suggest, have a look at the paper. Also, Eric Lonergan's work on this. But this could be something that's fairly straightforward to implement in the euro area.
Okay, that's something indeed quite technical to end with, but we should get to the end. Dorothea, is there anything you would like to comment on these questions? Also on the legitimacy, you said already something on that, but
one thing is, I wonder when I read the paper, it is very different from the known monetary policy. It's a step into another world, and as the ECB, in particular in our currency union, the ECB is already under pressure, and I asked myself whether such a step out of the known concept of monetary policy that is somehow inherited from the Bundesbank, would this really solve the issue of problems with legitimacy that the ECB has, in particular in the German public? So I have my doubts. I think the more the ECB deviates from the old Bundesbank style, the more the critics have more firepower.
Maybe to comment briefly on that, I mean, having worked at the Bundesbank for 6-7 years, and actually much of what's in this paper has been shaped by discussions with very smart people at the Bundesbank, is that I think it could actually be a lot more amenable to the German public. It's the Bundesbank has a long monetarist tradition. In essence, this is a certain monetarist instrument by directly impacting broad money without any of the unwanted consequences of QE. The concerns around fiscal dominance, which are essentially non-existent under this proposal, or very attenuated. So I think a lot of the traditional Bundesbank criticism that QE has faced, especially in the early stages, direct transfers wouldn't be subject to it. Now, on the issue of negative equity, it would weaken the central bank balance sheet. Again, it weakens the central bank balance sheet less than QE operations of similar magnitude. So actually, it's also preferable from that view. And I'm not saying central banks shouldn't have done QE. It's better than inaction. I'm just saying relative with other available tools, it would be preferable. And again, coming from the Bundesbank tradition, the Bundesbank actually had negative central bank equity, for example, in the 70s after the end of Bretton Woods due FX valuation effects, without endangering its ability to conduct monetary policy. Also, the Bundesbank actually engaged in the sort of direct transfer operation after reunification, right? When German Eastmark was converted to Westmark at a much appreciated exchange rate, which didn't reflect the market rate. And eventually that cost was borne actually by the Ministry of Finance. So there's a lot of precedents, I would say, from Bundesbank culture, which feed into this paper, into this proposal. Similarly, actually, the Bundesbank had a very good monthly bulletin on the issue why QE reserves cannot be lent out a few years ago. So I think those concerns are less than they might appear. And overall, I would say the role of economists and also this forum is to promote ideas that may not have been widely accepted, but will become so in the future. Inflation targeting was invented by, the Central Bank of New Zealand in the late 1980s. So those frameworks evolve, and I think evolve with the time. And I think that's something. My contribution is try to stimulate that debate and offer some aspects to inform that discussion.
Yeah, I fully agree with that. It is an idea that you should really discuss, and an idea that has a lot of technical issues which have to be solved. But of course, as you said, it's a start for new research.
Mm. Yes, excellent. I think we have had a very good discussion to better understand what the issues are. I think indeed the question is if what could be better than the current situation and the current tools, and if it's true that quantitative easing has contributed to speculative or to financial bubbles, if it's true that it has aggravated inequality and some things like you agree on both, then I mean we're in a situation where the credibility of the central banks is very much challenged, and we have to compare new tools or think about new tools and consider new tools before this background and compare what could be a better situation. And I mean, I talked about the negative impacts, the side effects of the central bank policy, quantitative easing. I mean, we won't start a discussion on that now, but it seems more or less it has not been very, very efficient. I mean, quantitative easing, if it has been to bring prices up, it has taken a lot of time, and I think we could agree on that this could be much more efficient. So if that's the case, then it's always to be compared, and maybe at some point new things arise, and that's a little bit our topic in talking about new economic ideas. Maybe at something where we will be accepted that we wouldn't have imagined to be accepted some time before. That's always been the case. In that sense, I think your contribution is very valuable, is very important, with a lot of open questions and technical issues and whatever. And that's, I mean, perfect that you openly address them and you admit that these are still to be answered. Thanks a lot, and thanks a lot to Dorothea, Sascha to have presented the paper and commented the paper. And we'll certainly get back to this question at some point. Maybe, if I understand correctly, Sascha, your paper, it will be at the next big crisis where maybe opportunities arise that then an immediate reaction may be asked for, and then maybe, unfortunately, we won't have the time to reflect on it, but maybe some work like you do may help to be productive at that time. Thanks a lot, and have a good evening or good day in Washington, and see you next time. Thank you.
Bye-bye.
Thank you both.
Bye.
Bye-bye.